the buzz which was there all around, suddenly is in last 9 months, we found that the growth was slowing down in India, that the biggest worry that markets are facing is all the noise around the Trump tariffs. We have now been trading closer to or below our 10-year historic averages. At this juncture, to sell large cap is a complete no-no.
Okay.
To start investing, definitely yes. Continuing SIP, a definite yes.
Welcome everyone. So the Indian market has been in a tight bear grip, and investors are scared, unsure, and are full of questions whether to continue investing on a quick or exit. And those who are on the fences are wondering whether to enter the market or not. There are other questions as well, like when is the market bottoming out? Should the investor diversify to other asset classes like gold and all? So discuss all those issues and get the answers to those questions. We have with us Amisha Vora, chairperson and managing director, Prabhudas Lilladher. Welcome, ma'am. Okay, so my first question is whether, the Indian equity market has been going through a tough phase. When do you see the light at the end of the tunnel?
So, if you see from the fastest growing economy, the buzz which was there all around, suddenly is in last 9 months, we found that the growth was slowing down in India compared to what was expected. Because of spate of elections, national, multiple state elections, the government spending was lower than budgeted on capital account, which also had its impact on the capital goods side of the industry, steel, cement, etc., etc. On the top of it, because of incessant selling by FIIs, as what we all know, and RBI's intervention, or even otherwise, the domestic liquidity became very tight. That also impacted the growth. And lastly, because of vegetable prices, duty on palm oil, the consumer price index, inflation, which used to hover between 4 and 5, just shot up to around 9.5, 10 in October, November. So all these put together started impacting our corporate results. So this quarter, the October to December quarter results did not come as per expectation, and that provided a very severe ground for derating of the stocks. Having said that, and having realized that this is where the growth is slowing down, everyone started taking the right decisions. RBI started pumping in liquidity. Government in its budget gave fillip to domestic consumption by giving the relief in tax slabs and tax rates, and capital expenditure from government has also started. In the meantime, market has already corrected in large cap by almost 15 to 17% from the peak. And small caps have corrected by more than 20% as an index. But if you see, 70% of the stocks are down more than 30%. So there is a complete wealth erosion which is happening. Now, as we stand, we feel that the biggest worry that markets are facing is all the noise around the Trump tariffs and how it is going to impact different sectors, our exports, whether the Chinese imports will start coming in, impacting the domestic economy, rather domestic corporate profitability. So these are the worries which are there on the horizon. Having now understood that also, we feel that in large cap, particularly Nifty, at the 22,000, a lot of the pain is in the price. We have now been trading closer to or below our 10-year historic averages. So at this juncture, to sell large cap is a complete no-no.
Okay.
To start investing, definitely yes. Continuing SIP, a definite yes. What really will be the pain pocket of the markets will be micro cap, small cap, or SME, where the fundamentals were not justifying the valuations and price at all, and the management caliber also is question mark to navigate this economic outlook. So there, if the business do not bounce back, the prices can never bounce back. So then that is the place where investors will have to take a very informed decision to still cut losses and bring that money into quality stocks. Quality and growth is what market will be very specific about in the first phase of the next run.
So we can say that, as you said, some pockets of large cap stocks are now well priced, well valued. So does that mean that the benchmark indices like Nifty and Sensex, they'll now not go down as much as we're seeing in last 2-3 months? Are they going to kind of have a relief rally sort of thing? I mean, how do you see that maybe next 1 month or 2 month?
So I think that another 15% Nifty correction, I don't see it.
Okay.
Another 3 to 4% in or 5% in next 2 months, not impossible, because April beginning, the Trump Modi discussions on tariff will have to take shape, where both sides will, of course, try and negotiate hard. But a lot of statements further can be expected from Trump administration, wherein markets can feel the jitters. So that is not a very impossible outlook. But whether markets will correct over the next 4 months also 15% or 10%, I find that to be a very limited probability. Maybe I will give just 10% probability to that.
So for retail investors, what is your advice now?
I feel that what I very clearly said, particularly large cap, quality and growth combination, they should invest. If they have not invested, they should invest. If they are invested and stuck, important is to review the portfolio. Wherever, as what I said, there is a liquidity, quality of business is not good. What does quality of business mean? That business do not generate cash, business is laden with debt, there is no 15-20% growth or return on equity. These are the parameters which says that the business is not great, so it will be difficult to bounce back. So take that cash, put it into better quality stocks. Particularly, we as a house are recommending, say, pharma stocks, healthcare and hospitals. So reshuffle here. These are more immune compared to others. But in pharma, particularly, some kind of tariff rejig is bound to happen. So be prepared for a little volatility. We are very bullish on, say, hotels. We are very bullish on defense stocks, because defense, none of these world ups and downs, be it trade war or currency, is going to impact. Orders are there in hand, they have to execute in time. So that also, we think that the sector gives a lot of visibility. Experiencing is the key theme, if you know, in the younger generation in India. So be it your theater, be it your hotels, they will do very well across the chain. Similarly, we feel some part of domestic consumption will start doing well from second half, given the budget rollouts. So consumer non-durables is the space we will look at. So like that, better sectors, reshuffle your portfolio.
So now some people are also saying that you should diversify across asset class and geographies. What is your advice on that? If at all people needs to diversify.
See, diversification across asset class is a necessary must at all time. Be it good time for equity, be it bad time for equity.
Mhm.
Why? Because particularly gold is a hedge against currency from Indian perspective. So some portion allocation to gold was very necessary. What happened in last 12 months is that most of the global treasuries started replacing dollars to gold.
Mhm.
So there was a huge buying in gold and prices did very well. So if you are just not part in the gold, you miss out on this move. Secondly, why you keep some amount of fixed income is equity as an asset class is very volatile. So sometimes when you want to withdraw something, you don't get the right best time of the equity. So some portion in fixed income is very important so that you can dip into it. It gives you steady return. But depending on your age, younger you are, higher allocation to equity
Mhm.
is what the core principle is. So that you get the compounding impact of equity as an asset class for a longer period in your portfolio. But asset mix, diversification across asset class is very important, as what I said, in good and bad, both the markets.
Mhm. And in terms of geographical diversification, do you think India uh, doesn't allow you as much, to diversify across geographies? Regulatory restrictions are there. So, how should people go about it?
There are two aspects to it. In terms of uh, Indian market breadth across listed companies and its sectors is very good. So from Indian market perspective, we get very good choice. But for example, US technology or say China technology are like did well or as China technology is likely to do well. So you will have to invest basis your LRS limit. Now
Mhm.
that LRS limit and other things are applicable to HNI and ultra HNI. Retail as such cannot much participate except some mutual fund which is some portion allocated to it. But for sure, HNI and ultra HNI should participate and hedge out their portfolio across different economies.
Hmm. Okay, so while investing and making a portfolio for herself, I mean, retail investors I mean, we have seen recently that they were too gung ho about mid cap and small cap small cap stocks, and they invested a lot. Probably ignored the large cap stocks. So ideally, in your portfolio, what should be the proportion of large cap, small, mid cap stocks? Retail investors.
It also depends on the economic growth,
Mm,
market cycle,
mm,
and age profile of the investor or risk profile, not age, but the risk profile of the investor.
mm,
This decision of allocation. But looking at current economic cycle of India, current market cycle of India, we recommend that almost 60% be in large cap, liquid, quality names, about 25% in mid cap, quality names, and 10 to 15% only be allocated to small cap.
mhm. Okay. Okay. So, FIIs, uh, we're pulling out from Indian stock markets. Uh, do you think like you said that some pockets of large caps are now well valued, cheaply valued, so attractively valued. So, do you think FII should start coming, or are there still some pain? And are there? I mean, there are some other factors that are driving out FIIs.
So last 3 to 4 months since the time it got confirmed that it is going to be Trump administration,
Yeah.
the dollar took a strong rally. And so the first trade which got changed is emerging markets as a class became less attractive and a lot of focus went back to developed markets, particularly US markets, both because of strong dollar as also his announcement on tariffs to protect US economy, but US industry, but beyond that, tax cuts. So people, investors at large globally felt that US market itself is a good tough. Now the trade continued for last 4 months. We feel that it cannot continue forever because the real demographic power, the power of consumption is with economies like India, where our balance sheet of government is still very strong. We are not so highly leveraged globally or in India. So the trend will reverse sooner than later.
Okay.
When the combination of Indian market valuations starting to look attractive, Indian economy's growth starting to bounce back from a little slowdown that it got into a patch, and beyond all, the tariff policies of Trump, if implemented, we feel will be very harsh on dollar itself and the inflation in US. So I think sooner this conjuncture will happen and FI's flows will start coming back to Indian markets.
Okay. So as you said that you are bullish on consumption theme in India. What gives you that confidence? Because if you look at some other reports, recently there was a report that said that only 10% of India's population is actually consuming whatever is produced in India. Most of others are in distress. So what makes you so confident that about India's consumption story?
Two very important things that in any consumption, India's spending of the mass and the middle class, first fillip given by budget is the tax rebate. So, in average, 1.5 crore working population will get 80,000 rupees more in their hands starting April 25 during the year 25-26. That is a good amount of money. You can start paying, for example, your hafta, meaning your monthly payment, either for your scooter, two-wheeler, or for your new, for all you know, fridge or washing machine, or your one travel. So somewhere or other, this money will get invested. Second important thing is you always spend, if you are in any class, petrol and diesel. The oil softening is very positive on the pockets of the large population. So even if you save, say because of the oil prices which have come down from an average of 85, 90 to 70, you save say 1,000 rupees a month or 2,000 rupees a month, you will reallocate and spend somewhere. So it benefits you two ways. Your forex on oil comes down and you spend on something else which is in India. So both this plus last year from rural economy, we were getting positive inputs that the rural growth is slightly reviving. If that also continues, then we will have little across the board improvement in domestic consumption.
That you talked about tax cut. So now there is a section of large investor. So they are saying that because the government increased the capital gains tax last year, this is also one of the reasons why FIIs are now not finding India as attractive as it was earlier. What's your take on that?
So I feel that whenever if there is markets are going to go do well and you're going to make money, I don't think you will make so much fuss about paying tax on the money that you make. So underlying core reasons were expensive Indian markets and decelerating growth. If that combination changes to accelerating growth and reasonably priced markets, then tax can't be the large reason. And I still feel that capital gain tax, when you compare to US, is still attractive.
Okay. But ma'am, some people say that, in 2005, when the capital gains tax was removed, they brought in STDs, securities transaction tax. Now you have both STD and capital gains tax. That is playing, that is
That's a
making,
very valid argument.
that's a valid.
That argument we've been consistently posting with government that this is going to hurt both the ways. Same argument holds true for dividend distribution tax, dividend tax.
Okay.
Companies pay tax, then they earn net profit.
Yeah.
If out of that they distribute dividend, once again we have to pay tax on the dividend that we get. So it's a double taxation again.
Yeah.
Correct? First we pay GST, acceptable. We need that for growth. After that, we earn some profit. We pay taxation as a company. After that, if investors are getting dividend of that post-state paid profit, still they have to pay tax. But maybe for all you know, that is the state of a developing economy where revenues are required to fund our growth challenges in defense, infrastructure, ports, and of course, so many of us, we have to pull all our other Indians also above the poverty line. We have to take care of them. But yes, double taxation is happening both in dividend and STT and long term, and that argument is very valid.
Okay. So, do you think we are overtaxed? We are a overtaxed country, at least for some people.
No, but that some people will have to take the burden of larger population because in that lies their own growth. In that lies their own safety. So we will have to be considerate about it. If we spend on our defense and if maybe I can afford more than my other fellow citizens, but still that is the safety we are creating for our own nation. So till the time the collected tax is used very carefully, I would still go for it. But like how pragmatically this government behaved in giving tax rebate, tax reduction to masses, if they behave at the right time more pragmatically and give this double taxation if they avoid, I'm sure markets, investors, domestic and global will respond very, very positively.
So, Finance
And
Minister,
as the base increases, your revenue will still be protected. That's what the core belief one needs to have.
okay. So, Finance Minister recently said that they are soon going to reduce the GST rates as well. So, do you think this would also give a boost to the consumption story?
Definitely. Definitely.
Okay. So, ma'am, last year there were some regulatory, changes to curb, participation of retail investor in F&O segment. Do you think that has also played spoil sports for the market?
In terms of volumes, yes, because volumes have definitely reduced, but volumes have reduced by 30% plus in cash segment also.
Okay.
And this is very typical whenever you don't make profits repeatedly and quickly in a upwardly trending market, you get stuck with your position. And that's how volume takes a toll. But I somehow feel that excessive emphasis on F&O and changes have impacted F&O volume, but I'm sure somewhere it would have saved a lot of losses which otherwise investors would have done. And there would have been at least awareness that when you are taking F&O positions, take out little more time and understand and learn. Because there are professional traders who do very well.
Okay. So now let me draw you to a debate that was raising a few days back that was about whether retail investors should stop their SIPs, especially in mid cap and small cap funds. I mean, do you have a view on that?
So, stop their SIP? No. Rebalance or redirect it to either flexi cap, where professional fund manager will be very smart enough to know that how much he should allocate to large cap.
Mm.
Because, as what I said, looking at the combination of growth and market cycle, and how much to small cap. That decision, if they leave to professional fund manager, will be much better than putting a larger part in small cap, thinking that the return will be higher. We always have to see risk and return combination, because in small cap, the risks are also very high
Yeah.
because of their illiquid nature, because of their management capability and bandwidth being limited. So those risks one runs.
Mhm. So one last question, ma'am. I mean, apart from consumption, which was a concern, and now you are saying that consumption would pick up, private sector investment is another area of concern. Somehow it is not picking up despite all the incentives, PLI, and everything, even tax break. Why do you think this is happening? And do you think it has something to do with slow growth in consumption? So people are not adding newer capacity. What's I mean, and how do you get out of this cycle?
So private sector consumption, if you see, uh, be it there are
Investment,
commodity
not
led,
consumption, private sector investment. Yeah.
sorry, investments, if you see,
Hmm.
it is commodity led, infrastructure led, commodity led meaning expansion in steel, aluminum, cement, whatever, uh, and more such commodities, of course, refineries, etc. Second leg of private sector expenditure happens in infrastructure also. So bidding for whatever, airports, roads, this, that. And last leg is in automation, expanding your capacities for whatever product that you are doing, be it in auto, pharma, etc. And modernizing your plants or automating. So if you ask me, the first growth in capex, that is in cement, steel, aluminum, oil, and gas refineries, is very limited. These are global commodities. With slowdown in China, the pressure on through imports continued to be a looming fear, and our own capacity utilization is also at a okay level, not very
Hmm.
uh, high level. So it's a
Okay.
combination how it works out. The second leg of the infrastructure led, the earlier experience was so bad, and lots of companies went under, banks piled up, uh, you know, NPAs. So this time it is private public, public private partnership is working limited way. It is more public money which is going into infrastructure.
Okay.
But the last leg, if you see, the capex on data center, capex on expanding your own capacities with the PLI led. But PLI led expansion, the capex requirement compared to the total is very less. They are a high multiplier to capex to sales. Then your expansion into, say, solar, all that is happening at a very high speed.
Okay.
But the first two is not shaping up.
Uh,
That is how we see that private sector capex remains impacted.
hmm. Okay, ma'am. Thank you. Thanks for your your candid answers. That was very helpful. Thank you. Thanks. Thanks for.
My pleasure. Thank
Thank
you.
you.